Thanks.
Thank you, David. It's a pleasure to be here and to introduce this very interesting panel. Well, first of all, as I said, introducing the participants, I realized that I'm maybe the only one that may need an introduction, considering the caliber of the people on this panel. Let's put it down to the fact that I'm based in London. But my role, besides being the director of the IFE and co-chair of its Investor Risk Committee group, is that of a quant-based fund manager based in London who's been in this business for, I think, the most part of the last 15 years. And that's the most, I think, presentation that I will do, because, as I said, my colleagues here in the panel are well known to many of you. As far as Rick Bookstaver, I think the Wall Street Journal did the job for us. I think a few of you will have seen his nice picture of this, as well as the article on Friday on the money investing version of the journal. Rick has been in this business for a long time, since the mid-80s, and before that he was an academic, and he has very, very good insights, both as a long-term practitioner in this space and as a manager. This is a most recent undertaking, a manager of equity market neutral strategies managed in a quant way. So it's a very, very well qualified and insightful speaker to have. Following suit is Harvey Stein, who's the head of quantitative finance research and development team at Bloomberg. Another person that has a very, very distinguished background, mathematics, and studying mathematics, and then a number of roles in the quant world. And it's a well-known and very, very effective speaker. The third, last but certainly not least, Ramu Thakarajan. He's a principal at Pickwick Capital Management, but many of us will remember his seminal work on earnings quality while he was an academic, and he had, before the current appointment, a number of very distinguished appointments in quantitative and equity management. So you have three quant managers in the panel, and a person that is involved on a daily basis on the provision of analytical information with a quant slant to it. I think considering that the industry certainly has and developed a lot, and this particular audience certainly has a quant tilt to it, or quant slant to it, but it's diverse in many ways in the approach to quant. I thought one of the first things that we would do is try and understand what we mean with quant. And to this effect, I will ask each of the panelists to tell us something about themselves and how they relate to the quant investment management. I'll ask Rick to start.
Yeah, thank you. It's a pleasure to be here this morning. I have been in different areas of quantitative finance over the course of my career. I started out in options theory in the 1980s, and then did tick-by-tick based proprietary trading, and then risk management, which of course by nature is quantitative. And over the last 3 years, I moved into probably the least complex of quantitative areas, which, at least in terms of being more linear and so on, which is quantitative equities. I run a portfolio that's long-short equity. Unlike Jim Simon and others, I haven't had the sterling success at it, and maybe as we go through things with the panel, I can go through some of my views about the future of quantitative trading methods, especially in the equity market. But my view is that as more people go into that space, things do get arbitraged away. We started to see that with stat arb as we moved from the 1990s to the early period of the 2000s. I think around 2002, a lot of stat arb strategies started to diminish. But my biggest focus, and as was mentioned, I was in a Wall Street Journal article. Somebody said that there's a caricature of me, and somebody said I should be writing to demand that they do a refutation of the caricature. But in any case, I've written a book called A Demon of Our Own Design, which points to two areas I think cause crisis for financial markets, and both of them really point very strongly to many quantitative methods. One is financial innovations, that is derivatives and complex products, which I think by making the market more complex increase the nature of and the frequency of crises. And the second, which again is very important for quantitative work, is leverage. And the reason is that most quantitative methods focus on a very narrow component of the information that's driving the market. And because they're only looking at a small, maybe 10% of the total picture, they have to lever that up substantially to get to amplify the signal to the point that they get decent alpha. With LTCM, you could see that with relative value trading, where you might see a differential that's a matter of 20, 30 basis points, so you have to lever enormously to get returns that are 15, 20, 30%. Or with long-short equity, if you look at the anomalies literature, you can see this, that typically the sorts of anomalies that people try to seize upon are considered strong if they generate alpha over a period of a year of 2, 3, 4%. So again, you have to lever pretty substantially. My view, and having done this, my view reinforced by practice, is that the leverage that comes with that brings with it a lot of risks, both for the portfolio and for the market. And so my focus, I think, in looking at the quantitative strategies and their approaches in hedge funds is not so much to look at what maybe most people in the audience want to look at, which is how can I make money at this? Where's my next job in it? But rather that, I believe that the complexity that comes from quantitative strategies and the leverage that's really required for many quantitative strategies poses a large risk to the market. And I wouldn't be surprised if over the course of the next 2 to 5 years, we start to see both of those become more and more expensive to execute. Because I think regulators will become more aware of the risks that are posed.
Ramu?
I'm delighted to be here at the conference today. I'm Ramu Tyagarajan. I head all the quantitative strategies in Pequot Capital Management. Before I joined Art Samberg, I was the head of all active quantitative strategies, equity strategies in Mellon Capital Management based in San Francisco. And in addition to equity, we've done a fair amount of work on fixed income credit spread strategies, asset allocation strategies, and some currency strategies. So Mellon, as you know, is a large quantitative shop. Prior to that, I was a professor of accounting. I was in the dark world of academics, like many of my distinguished panel members here. And Kellogg for a number of years, where I've written many papers, including the one on earnings quality that Giovanni was referring to. In Pequot, our quantitative strategies are primarily based on fundamental analysis. Pequot, as many of you know, has got a large number of great fundamental analysts in many, many different sectors. It's over 100. And one of the things that we have done here is to take the signals that is traditionally used and try to calibrate it as much as we can for different global sectors. The models that we have draw heavily on accounting anomalies. We'll talk about that in a few minutes, and valuation ideas. And we build in transaction costs as an important part of the model as well. Now, I have to concur with my colleague here with respect to the declining returns to factors. You see the chart, and we'll talk more about that in a bit. As the returns to factors keep going down, and equity walls keep coming down, the leverage seems to become more and more important. And in order to meet the return expectations of our clients, it's become increasingly necessary to deploy leverage. I am greatly concerned about that. And I do think that unless appropriate risk controls are in place, particularly as volatility spikes, as we will see going forward, we could have a rocky situation. We try to calibrate it as much as possible on two ends. One is to calibrate the return expectations of our clients, and second, more importantly, to manage it at the portfolio level. But having said that, we live in a world where levering a portfolio, particularly in a strategy such as the equity market neutral strategy, 3 to 8 times has become fairly the norm, and that can be very serious as we go forward. With that, I'll turn it over to colleague here.
Hi, Harvey Steiner on the Quant Group at Bloomberg. It's a small company that sells what's known as the Bloomberg Terminal, has a little bit of data, some analytics on it, a little bit of news. People tend to use it to try to get a view of the market.
Niche business.
Yeah, a little bit of a niche. So, so thank you for having me here. Glad to come out and share my views from the other side of the kind of the other side of the world, not where we're buying and selling, but where we're trying to help everybody else do so. So, kind of a little bit from an arm's reach. I'm watching things that are going on and wondering a little bit about them, thinking about them. My expertise is mostly in option pricing theory, arbitrage pricing theory. We've been building models to price derivatives in the interest rate markets and credit markets, equity derivatives, FX. We've done a lot of work in the FX world of late. Didn't quite start in mortgages, but after working a little at Bloomberg, I moved into the mortgage world, pricing MBSs, CMOs, did a lot of work there. And what strikes me most recently about the markets is just the growth and complexity of the instruments being sold. Now, of course, there's always been a lot of complexity in the mortgage markets, but the leverage, in certain respects, the leverage is a little different. So I don't think the securities have kind of such a broad range in P&L as you see, say, in just general structured notes and equities, equity-based structured notes. And it's kind of a funny bit of an arms race to see going on, where the sell side is trying to push out more and more complex strategies to tailor, to specialize partitioning of risks for the clients, as well as to preserve their own spreads in trading these things, while the sell side or the buy side goes back and tries to figure out exactly how they should price it and how to value one against another. While Bloomberg then comes in and tries to figure it out as well, and once we come in and bring out the new models, then the sell side moves on to something else, which is no longer a commodity item.
Well, thank you. It's a very, very insightful view, I think, of the overview of the markets where we're going. A thread of pessimism and concern, I'd say pessimism maybe not, but concern there expressed by all three speakers there, to which I associate mine. Our session is on quant trading. In many ways, notions that we've mentioned, like complexity, leverage, have been associated with quant trading. And I think in many ways we need to try and define what we mean with quant trading a bit more precisely. I understand it's a difficult task, certainly. But quant, in the end, is something that we all use, no matter how much fundamentals-driven or casually oriented in trading we can be. Spreadsheets, models are things that are necessary at this point. Execution is becoming more and more quantitative through algorithms and a number of other ways. So let me ask our panelists what they think is quant trading, and whether we can identify a group of strategies or a group or a way of doing trading that either by the way it's done, or by frequency of trading, or by the volume, or by the timing horizon for the forecasts, can be qualified as quant. And is that different, significantly different, and is that then a particularly important component in this concern that is around, or is it an especially important component in what could cause a crisis in the market? Let me go in reverse this way. Let me ask Avi to see what he thinks.
Well, what I think of quantitative trading is essentially trying to use models of various processes to find trading opportunities and to lock in returns one way or another. You know, you contrasted with, I guess you could contrast it with fundamental analysis, where you look at ledger sheets and cash flows for a company, and try to compare different companies and industries, and compare industries to each other. Think of quantitative trading much more as trying to isolate particular risks through derivative instruments in an effort to capitalize on precisely the risks, or take precisely the bets that you want to take without exposing yourself to other risks.
Rick, you've been in many roles in this business, both in active management and in risk management roles. So you've seen a number of ways of trading that can be legitimately called quant. What's your view? What do you think is there something that can be called quant trading?
Yeah. If I were to define, thinking of the equity space, which is what I'm in now, and probably by analogy, you could then extend it to other spaces as well. I'd say, I agree with Harvey that, it's model-driven trading. But I think it can be instructive to look at it in the spectrum of the average holding period. So at the extreme, you have high-frequency trading, which almost by nature has to be quantitative if you're going to scale at all, because otherwise you're a day trader. And one step removed from that is stat arb trading, which is looking at short-term, typically anyway, short-term reversions. So these are this is where there's a real arms race that goes on, and Harvey mentioned an arms race in terms of derivatives. I think another arms race that occurs is trying to grab information and execute it quickly. I believe that the high-frequency type of trading is somewhat restrictive, both because there's so much intellectual capital and hardware being thrown at it, and because it can't really scale very well. Then if you move out a little bit, you have sort of the anomalies-related model-based trading, where you can cull through the literature and just find anomalies that different researchers, academics have found, and you can trade based on those anomalies. Post-earnings announcement drift would be an example of one of these. And those typically have holding periods that are on the order of weeks to a few months. Then I think if you go a little further out, you have factor-based approaches, which again are inherently model-based because you're not trading stocks, you're trading a common theme or characteristic within stocks. It can be high cap versus low cap, would be a simple example, where the stocks are just a conduit to extract a factor. And of course, to do that, you have to use quantitative methods because you're sort of creating a portfolio that's hedging out everything except this one factor. And those tend to be longer lived and may have holding periods that are measured in months to, usually months. I don't know that many of these last more than a year. And then you sort of have what you're doing with, or I assume you're doing at Pequot, which is pure essentially trying to create an artificial intelligence version of an analyst who can look at the same sorts of things an analyst looks at, and maybe doesn't do it as well, but as the saying goes, makes up for it in volume and in better risk control. And in that case, the holding period could be months to over a year.
Yeah, we do try to get into the head of a good fundamental analyst and try to model that intelligence sector by sector, and adding to what just Rick said, our holding period for that type of model is higher than 2 to 3 months, depending on the sector. We do run factor-based models, and so in some of the ones that I've referred to in the slide, things like earnings momentum, we call the literature some that I've contributed to myself, earnings quality and valuation, and those are important components of the model. And what we have done is to try and enhance that with trying to modify that by sector by looking into what works and what doesn't, and why that's the case by talking to the fundamental analyst. And the holding period varies depending on the sector, and in my mind that's sort of related to the mean reversion notion. When you think of quant trading, adding to what Rick said, basically we are sort of trading on a mean reversion notion. Spreads get very wide, and you want to get a position so that when they go back to equilibrium, you can make money. Depending on the asset class, whether it be option adjusted spread for credit instruments, whether it be returns or expected return spreads for equities, or stock bond spread for asset allocation models. And that's something that's important, because you have a view with respect to what the world ought to be based on your modeling of it. So you're agnostic about what a fundamental analyst says. You're going to go trade based on that. But when it comes to equities, that type of thinking has to be very careful, because that just doesn't work in many sectors. So what we have benefited immensely from being on the Pequot platform is to be able to find out where it doesn't work and why it doesn't work, and how we can learn better what we don't know well. And that, I think, is very important in quant trading. One of the important things that's different between what we do and what some of the other portfolio managers do is thematic plays. A fundamental analyst will basically do a thematic play, whether it be a solar play when it comes to places like Germany, or an infrastructure play in India, or whether the big thing now, one of the big things is water as a commodity. So you go long, you take sort of a beta bet, you hold it for a number of months, sometimes longer than that, and then you hedge that risk out with some kind of derivative instrument, whether it be the S&P futures or some kind of, depending on the country, you take some kind of index future. One last thing I would say is that the difference between what we have observed and what I've been trained in with respect to quantitative modeling and what typically fundamental analysts do is what I believe is to be a growth assumption variance. We look at trading from a quant perspective based on some expectation of growth for companies, based on some data structure which we screen, which we make sure it's correct. Whereas a fundamental analyst will have a very different view of growth, and you can have many fundamental analysts go long stocks like RIM or CME or Google and hold it. Though most models would just say these are cryingly expensive and you just don't want to go near them. So that I believe to be a very fundamentally different between quant trading and what I've seen to be very important, very successful fundamental trading.
I'd say very little to add from my perspective, not as moderator, but as quant trader myself. I'd say taxonomy that we've identified, whether the frequency of trading and the period that you're forecasting in is crucial in determining what kind of trading you do. Is certainly one that we share, as well as the idea and the conviction that the high-end frequency side of things, or quantitative things, there's very little juice that can be squeezed out of the fact, on one hand, that there are significant amounts of capital being deployed, as Rick was saying, both in terms of investment into just sheer computing power, and also in terms of capital being deployed in the market to exploit anomalies that are very, very short term. But also, I would add, by the fact that more and more of the traditional buy-side institutions are trading using algorithms. So are trading using, at least to some extent, some concepts that up until a few years ago were used in statistical arbitrage and now used just purely as a utility to try and smoothen up the trading. But also the view of trading has changed in many ways to one that takes into account things like market impact, execution over a certain period of time, all concepts that belong to the quantitative world and were used principally by quantitative managers, but now are very widespread in our industry. Looking at quant management in general, do we have a sense of how large it is? There are many houses in the traditional world and quantitative and alternative world that use quant. Do we have a sense of whether it's a business that is growing, or is it shrinking, or is it staying the same? And a question that is very, very closely related to that is, if it's a business that is growing, is it a business that is growing in a sustainable way, or is it sowing its seeds of its own destruction by arbitraging itself away? Who wants to pick up this one first? Ramon.
As my friends in BGI used to say, the first 100 billion is the most difficult, the rest of the trillion is easy. Quant trading the attractive thing about quant trading is extremely scalable. And it's very attractive. It's got nice properties depending on the type of strategy that you have. That fits into nice asset allocation models that most allocators use, whether it be fund of funds or plan sponsors or foundations. It's also attractive for fundamental shops in order to have a diversifying source of revenue that's also scalable. You have a platform that you can leverage and you can use it in multiple asset classes. Has that grown too large? We certainly hope not. We do think that given the fact that you are agnostic about a particular theme, you try to do your trading based on equilibrium models. You can be scalable in multiple different asset classes and areas, and more importantly, try to be very clever in combining different types of strategies into something that can be useful in varying times. There are times, for example, that we saw in 2003 when it was pure junk rally, when quantitative strategies needed to be modified. So when you are nimble about that, and quantitative strategies can certainly be that way, you can adapt and accordingly address manage a large number of assets. Having said that, because of that very notion that it is scalable, a lot of people are doing it. Most large hedge funds have their quantitative arm. And there are the large players such as the BGI, the State Street, and so forth. You will find over time deterioration of returns, and you see that on the chart. You got the blue bar is the earnings momentum signal, the brown bar is the earnings quality signal, and the yellow bar is the valuation signal. And you find that over the period 98 to 01 and to 05 to 07, there's a significant decline in the 3-month forward-looking factor returns for a quintile portfolio. That will happen. And as rational people, as portfolio managers expecting that to happen, we should try to be nimble, and we try to be creative in what you can do to adapt your models. For example, when it comes to earnings quality, you can't just look at the total accruals. And I contributed to that literature. That's become a commodity now, and that's not something that can add one heck of a lot anymore. So you need to dig deeper. You need to look at the difference between tax income and financial reporting income. You need to look at footnotes. And a lot of hedge funds do this, where they have people in places like India and China sit through and look through financial statement footnotes and come up with databases. That's important to do that. You need to think about where things don't work. and try to allocate your risk budget accordingly. That's very important. There will be times when you'll find that factors just don't work in some sectors, and you have to walk away from them instead of trying to take exposures in every single sector. And I think if you continue to do that, you can have a role. Quantitative strategies will have a role. Whether it has become too big at this point, I don't think it has.
If I could just comment a little further on that, I think, both Giovanni and I sort of went through the view that on the very high frequency side, there may be compression to the point that we're getting a lot of the opportunities diminishing. And that's the result of, I think also that there's only so much stock that's traded. And, as Giovanni pointed out, there's a lot of algorithms now that are available essentially for free that every portfolio manager can use. So you could be a portfolio manager, you don't even care if it's actually generating alpha. If it just reduces your transactions costs by 50%, you can do it. Whereas the hurdle is much greater than that if you're trying to actually make it your business. You have to make positive alpha. I think one of the things that Ramu mentioned, or just the general tone of the way that he was going through it, I think gives a sense that I could restate as sort of somewhat of a death knell for quantitative trading. Because, well, first of all, if you look at anomalies in the academic literature, the half-life of those anomalies seems to be diminishing. There's a paper, I think it's by, actually I can't remember who it was by. I'm sorry, I'm going to give you a citation without a name, but there's a paper that was in a book that went through a number of anomalies that worked for a period of time, then stopped working, and there are several hypotheses. One is they were arbed away. The other was that it was just maybe coincidental that they happened to work over that time, and this is going to happen. I mean, it's not like an anomaly gets investigated just by luck. It's sort of out there in the air, and an academic seizes on it, tests it, and sure enough, it exists. Well, the reason he tested it in the first place was probably because there's a general sense that it was there. So this is not, pure, it's not removed from an ex post selection bias in the anomalies that are looked at. So another one, the post-earnings announcement drift that I mentioned tends not to work as well. It could be that's being arbed away by many people using it, or it could just be that that companies are being more forthright and clear in their earnings statements, and the analysts and portfolio managers are understanding more, what they had in mind. So I think getting to Ramu's comment that if you say, yes, I think that quantitative strategies can persist and continue to do well, it's just that you're going to have a team of people in India going through every footnote, and every few months you have to recalibrate and change your model because the previous one didn't work anymore. That, I guess that's quantitative trading, but it's a lot different than I think most of us thought quantitative trading was some time ago, which was you developed a model that sort of represented the world, and you could trade on that, and it generally worked. If now it depends on the sector and depends on getting specialized data and requires constant updating and changing, it's starting to look more and more like a portfolio manager who is good with a computer. And it's still quantitative, but it's not quite what I think many of us would have envisioned quantitative trading as being, even now, much less, some years ago.
I have to concur with that. I think only quick comment I would add say that I think if in the past you sort of developed a model, I've been in situations where there was an asset allocation model that was sacrosanct. You didn't touch it. That's the third rail, so to speak. You don't touch it. And if you believe that's what it is, unless you have $1 trillion in assets, you can't hope to be in business unless you reinvent yourself. You've got to be innovative, and part of it, and maybe the definition of quant trading itself varies over time, and you've got to be that way. The other thing, as my friend Myron Scholes likes to say, you've got to have multiple cylinders working in any quant model. if it cannot be just a simple asset allocation model or a credit spread model and hoping that it will work, that's why one of the things we think about is a global model. You got 11 countries or 12 countries. You got multiple factors. You got sector selection models. You got not only stock selection. You got country selection models and some currency models. If you look at most multi-strat models that you see in hedge fund shops, they have multiple cylinders working, and that's the only way you can hope to reach your expectation with respect to returns. And if you don't do that, then unless your asset base is very large, you won't be in business for too long.
Harvey?
Yeah. I think that barring a collapse of civilization, the world's not going to get any simpler. Things are going to continue to get more complex and requiring more sophistication. And the question of whether quants are essentially going to make themselves obsolete, which is kind of what we're asking here, is it's a matter of trying to gauge how much opportunity is out there versus how much opportunity we know about. How much is unknown. It's kind of hard to know how much you don't know. My colleagues were talking about noticing anomalies, capitalizing them, and seeing them go away. Well, what happens after that? Presumably, when people aren't capitalizing on them, they're liable to return. So there's a source of kind of self-correction or renewed opportunity in the markets. There's a half-life that any organization has, kind of a memory half-life, where it forgets things that it used to know because it's doing different things than it used to do. These opportunities will potentially come back because of that as well. There are other controls in the markets, built-in controls like bankruptcy, where a company stops being good at exploiting the things it was finding, or the things it was finding are no longer there to be found. It doesn't make money, or it takes on more risks than it can manage and blows up, or it doesn't have the will to control its own success, to stop a trader that's successful because despite the risks he's taking on. And these are all effects that happen. These are all things that are happening on an ongoing basis in the markets, and continue to make opportunities for those who have a certain degree of sophistication, or sufficient sophistication and control expertise to capitalize on them.
It's a very, very interesting set of observations, and I'm sure you're enjoying the session as much as I'm doing here. Let me broaden for a second the view of what we just said. And really, we've been talking about whether quant can survive and whether it's going to be a victim of its own success. Let's try and look at maybe more systemic considerations. Quant has been in the past associated, rightly or wrongly, and we'll ask our panelists what they think about that, with great success and great failures. Is there something typically in the way in which it provides or draws liquidity from the market, or in the way in which it uses leverage, or in the way in which models are tested and put together, and the assumptions behind the models are put together and considered, that make quant trading especially vulnerable, or to be the cause of problems, or to exacerbate the cause of problems? I think in Rick's book there's a reference to 1987 and how undoubtedly quant trading created problems in that situation. Or is it really something that is beneficial in terms of liquidity provision in a number of other ways in normal times as well as in abnormal times? Who wants to start with that?
Well, let me, I hate to do this. I mean, anytime you write a book, of course, you always talk about things having to do with the book, but it's natural because that's why you wrote the book in the first place. In the book that just came out that I did, the basic premise of it is, as I mentioned earlier, that, well, the starting point is that economic risk has actually diminished over the last 20, 30, 40 years. Whether you look at variability of GDP, the frequency and depth of recessions. By most measures, we have less economic risk now than we did, say, 20, 30, 40 years ago. Yet, our markets are more crisis-prone than they have been historically. You know, the biggest crises, with the exception of the Great Depression and the crash in '29, the greatest crises that we've had in the 20th century occurred in the last couple of decades. The crash in '87, LTCM, the Asia crisis, the two biggest bubbles, the Nikkei and the internet bubble. So you sort of have to ask what's going on. You know, why is it that the exogenous risk is dropping and endogenous risk is rising? And I point to two components to it that I already mentioned that have sort of a leverage and complexity that are sort of at the core quantitative types of things. That is, complex instruments are sort of the home ground for a lot of people who are quantitative. Leverage is sort of required for quantitative types of strategies, much more than fundamental strategies, or for people who are doing spread-type trading. Let me give you an analogy to this that actually is the basis for using this in the book. There's a concept in engineering systems called normal accidents. It was coined by Professor Perot at Yale. And the concept of normal accidents, which are applied to nuclear power plants and to airlines and so on, is that when you have an engineering system that has two characteristics, it's nonlinearly complex, and it has a component called tight coupling, which means when one thing happens, there's no opportunity to intervene before the next thing happens, which, of course, is the case as a nuclear reactor goes towards criticality and so on. When those conditions exist, accidents are inevitable. You can't stop them. That's why they're called normal accidents. It's within the system that they will occur. And the problem is that if you try to stop them by adding safeguards, those safeguards themselves just increase the complexity of the system and make those accidents all the more likely to occur. So you sort of have to live with it or else reduce complexity and reduce tight coupling. And incidentally, if you look at Chernobyl and 3 Mile Island and ValueJet, which are sort of canonical examples of this, all those occurred because of the safeguards that were layered on top of the complexity that already existed in the system. So the analogy, I think, is fairly immediate to financial markets. We've basically designed financial markets to be a complex system. And the people who are largely to blame for that, I hate to, fortunately we're off the record, so, but who are to blame for that largely are the quantitative people, the people who come through academics, look at portfolio insurance, look at the complex derivative instruments that are developed, look at the academic pedigree behind this LTCM and the strategies that occurred there. And so I think, although most of the discussion that we have when we're talking about when we talk about financial engineering is more of the what can we design standpoint, my argument is that as you design each of these new cool new complex instruments that may or may not serve a vital function, along with them comes a negative externality because on the margin each one increases the complexity of the market that much more.
Well, very, very strong and very well argumented view. We're on the podium already, but Rick has put us all on the spot. Any views from our distinguished quants on the panel on the risk, inherent risk of quantitative strategies that Rick has just hinted at, and other risks that may be critical in a systemically difficult situation?
Can I maybe ask Rick to give a couple examples of kind of complex linkages, complex nonlinear linkages that you think could result in such, apparent behavior?
Historical or forward-looking?
Either way.
Okay. I think, historically, a simple linkage that we saw was, LTCM is a great example of this. They get picked on all the time, but it's just because it's out there. LTCM, the conflagration that caused the problems with LTCM came really from a crisis that they weren't even a party to. which was the default in Russia. They didn't even have large positions in Russia. But what happened is the people who did have those positions also happened to have positions that were shared by LTCM. So you had a strange situation where people, because of the stresses they were under and the leverage that they had and the fact that they were forced to make good on collateral and margin, when the crisis occurred in Russia, they had to liquidate. What do they liquidate? Well, not just Russian instruments, because those weren't very liquid. They go to mortgage bonds and other instruments that LCCM also held. Those markets were in a state of illiquidity at the time anyway, because basically the ARB unit at Solomon was being closed and everybody kind of knew paper was going to be thrown out on the street. So then LTCM has to liquidate. Their liquidation drops prices even more. The banks say, hey, you know that collateral you had? It's now only 80% what it was a few days ago. You'll need to liquidate due to our haircuts. They liquidate more, and you get this liquidity cycle. And the problem with that, and this occurs in a lot of markets, is that it doesn't have anything to do with economics. Who would have thought that a crisis in Russia would have a problem for a hedge fund that didn't even own anything or had almost no position in Russia? What matters is not just what happens, but who owns it and who's under stress and what else they own. And that's really complex, because basically every time people change their positions, the nature of the potential risk and propagation of a crisis in the market changes.
So you're talking predominantly in this case then about counterparty risk and kind of analyzing the chain of counterparties involved.
Yeah,
Which is a little bit different from actual risk of complex complex securities or transactions or plays themselves.
Well, LTCM is an example of that. I think the crash in '87 would be an example more of the complexity or the nonlinearity. The problem with the the complexity can be the instruments themselves, or it can be just the complexity in terms of ownership in the market.
You're talking about more about kind of the interconnectivity of the market.
Yeah. Or even think of, I give an example of organizational complexity, a Citigroup, where they sort of stumbled from one crisis to the next, and I think, in that type of complexity, you see also like NASA. I think NASA has the problem with the space shuttles was one more of organizational complexity. So I wouldn't pin it totally on nonlinear derivatives. I think it can appear in a lot of different places in the system.
A common line of sorry, I'll come back to it in a second, but a common line of defense to this argument, or one of the common lines of defense of this argument, is to say, well, look at, certainly we're looking at the crises, the 2 or 3 crises that have happened, but look at the ones that have not happened.
Yeah.
How do we feel about that?
Yeah. I mean, I think it's kind of like with the, I think it's true. That's not like every time something bad occurs, it sort of runs out of control. But that itself is a problem, and again, just to use an analogy, with the space shuttle, it wasn't as if when the space shuttle was designed, they had within the design specs foam debris falling every time there was a launch. But it happened. And every time it happened and there was no adverse consequence, it became more and more acceptable event until finally the engineers were in the sort of innocent until proven guilty phase of having to argue that this anomaly, this problem actually was one. So in a way, I guess I'm saying I can have it both ways. That if there is a crisis, there is, but if you have a lot of cases where things happen and there isn't a propagation and things don't run out of control, can you make the argument this just gets us more satisfied that everything's going to be fine down the road?
I think there's these from the Dutch tulip crisis to the high-tech crash, they tend to be centered around a certain kind of blindness, essentially kind of people being blinded by their own success. And then, in terms of in the quant space, it's natural to ask the question of what are people blinded to in the quant space, and I think what they're largely blinded to is is things that aren't easily quantified. Like, for example, political risks. What's going to happen to the markets because of the complexity, because of the interconnectivity? What's going to happen to the markets, or what's going to happen in my particular position if China decides to take action against North Korea? What's going to happen if Iran decides to, exert a more political influence through control on the oil spigot?
So regime change.
Or regime changes, or changes in tax laws, or changes in a country's attitude towards immigration.
That's not limited just to the quant space, though, right? I mean, when political risk or risk of that nature affects all types of portfolios, I mean,
not all types.
You would think that leverage would be an issue where, as a result of leverage, you have quantitative trading probably a little bit more suspect to this type of issue. And one of the things that I've seen over time, and at least one reason why people end up taking so much of risk, leverage, is the fee structure that we have. You have a 2-1-20 structure in many hedge funds, where you feel like in order to produce a net of fee returns that are acceptable to our clients, you need to do something. And one thing obviously you can do is to reduce the fee, which most people don't want to do. Therefore, you end up taking more risk. Lever the portfolio as much as you can. Then when you start doing more of that, then you're going to have problems that we see where results are coming from interconnectivity of things that you never planned for, end up hurting the portfolio and therefore hurting your business. So that I think is an important issue. And going forward, I hope that, I do know that when institutional asset managers come into the space, like the BGIs and so forth, there will be fee compression, and hopefully that will have an effect.
Yeah, just a personal note on this. I think this is a really important point, that the hedge fund that I'm running has had pre-fee returns of around 6 or 7%. It's nothing great. But after fees, it's like 3 or 4%, which isn't enough to really be sustainable. Now, it's doing that with leverage that is about 2.5 to 1. That is, gross exposure is about 2.5 times NAV. Well, a really simple solution to my predicament is to push that up to 5 to 1. Because then my returns, granted there's financing costs, but then my returns before fees are 11, 12, 13%, after fees 9%. It's not the world's greatest, but if I don't like that, I can make it 8 to 1. So I think there is kind of this tendency that, granted, if you're not beating LIBOR, you're sort of stuck. But if you're beating LIBOR by any measure, you can sort of argue, to make this thing work, given the 2 and 20, I just have to lever a little bit more. And it's amazing to me that there isn't sort of the alternative view, especially with quant methods where the argument is that they're not costly to run, to say, hey, maybe an alternative is to reduce the fees rather than increase the leverage.
But in what sense would this be different from, this is a point that Ramu made, and in what sense would this be, I can see in what sense this would be specific to quants because of this idea of diversification and leveraging and this producing small returns across the board of a portfolio. But then even in traditional management, we have risks that are there. We have portfolios that are not risk managed, although, Rick, I hear what you say, that we may be catering for things that we know and not really risk managing for things that we don't know about. But the traditional world has its own problems in terms of the investment management side of things. And in what sense do we think that traditional managers would be exempt from problems in this space? And then specifically to Ramu, you have described a process like yours that is a longer-term process, that is analyst-driven. Would that not be a process, reversion-based, would that not be a process that steps in situations in which there are massive opportunities, like a dislocation, and provides to the market some of the much-needed liquidity at that point?
I mean, when there are dislocations, we will step in and try to take advantage of that. But with respect to fundamental, how much of this is exposed primarily to quant and not the other side? Well, fundamental trading takes concentrated risk. You could have a portfolio manager have a 15% position in a stock. We have seen that big positions in a particular stock. So what happens is that the risk when things blow up sometimes are typically concentrate with respect to particular portfolios, whereas when quant trading, when you're levering it up on a large portfolio, when you're levering it up 8 to 1 times, and let's say you have a $4 billion portfolio levered up, it could have significant effects across the board. So it won't be isolated to a single portfolio. You have the prime brokers and the providers of credit pressurizing you, where you have to unwind at the most inopportune time. And when you know what happened when GM bonds were downgraded to junk status, FI. There was severe dislocation because it is a very significant portion of the Lehman Ag, and there were many hedge funds had significant positions in that, and when they had to unwind, so that would be the impact. That's the difference between what you see, at least what I see from the fundamental side versus the quantitative side.
And leverage doesn't have to just come from credit either.
True.
A $100 position in a stock, the stock drops 10%, you're out $10. You still have 90.
Right.
Corresponding, you take the money and you put it in an option at the money instead, and a small drop at maturity, you're out everything. So there are lots of different kinds of leverage. I'm not sure. Maybe one weakness in this whole game is an inability to really measure all the different kinds of risks that are involved.
And what we're saying is that quants are complicating the problem because we're looking at the risks that we know about and not necessarily the ones that we don't know about.
Well, there's that aspect,
Famous
and there's
knowns,
also
unknowns,
just a general there's just a general question of how exactly do you measure risk? I mean, what is the risk of holding an option? It has a delta of 0.5. It goes up and down half as fast as the stock. In a certain respect, it's less risky. But when you take into account the fact that it cost a tenth to buy the thing, then
right.
Suddenly, a 10% move is doubling your profits or wiping you out entirely.
Mm-hmm. There's a joke I'm sure many people have heard of, a drunk who's at a lamppost, down on his hands and knees, and a man walks by who's sober and says, what's the matter? Can I help you? He says, yeah, I lost my wallet and I can't find it. And the other man who's standing, who's sober, looks and can see plainly there's no wallet there. Says, are you sure? How do you know? Where did you lose it? He said, oh, I lost it in the alleyway over there. And so he says, well, so why are you looking here? And the drunk says, well, it's just a lot lighter here. Mm-hmm. And I think, when you're quantitatively oriented, there is kind of the tendency for us to focus a lot more where the light is. That is, where the data is, where the analytical methodologies are clear. And I think the sort of thing that, that you're talking about with accounting, most quantitative people don't want to touch something that's accounting, especially if it's footnotes, because it's sort of dirty and it doesn't, it's not in a nice, clean database. It's not tick data.
That's why we love it.
Yeah. And I think that's part of this risk that quantitative people have more than fundamentally oriented people, because if you're fundamentally oriented by nature, you're reading everything in the world and you're looking here and there and it's all kind of loose, but you can form sort of loose hypotheses. Whereas if you're quantitative, you're always focusing where the data is, or where the data are.
The critical thing is the speed and the volume. And if you're quantitatively trading using computers, based on your models, how quick are you going to be to pull the plug, to stop what's going on when things have shifted suddenly with your leverage tremendously against you? How fast are you going to be able to react to that?
Yeah.
I think this is a good point to open this up to the audience. I think it's a very interesting topic, a controversial one. You see difference of opinions in our panel. You can ask if there's a question on this or on other matters that we covered, but this particular one, Dan. Let me I just want you to just wait until you get the microphone.
Could I ask the panel to comment on the following proposition? Given that this is an engineering society, it seems to me that a lot of your comments are based around the idea that in traditional engineering disciplines, mechanical engineering, electrical engineering, we live in a world where the state variables are essentially constant. Physics works pretty much the same way now as it did 1 billion years ago. On the other hand, financial engineering is sort of hand of man rather than hand of God. And so the state variables tend to change rather rapidly and the conditions change. Isn't that really the basis of what makes all of this so hard?
It's a very interesting question. Who wants to take it up?
I think that that certainly makes it hard. And I argue, and actually Andy Lowe is going to be talking next, that the better analogy for us to use than physics or engineering for a lot of what goes on in finance is a biological system. But the notion of complexity and tight coupling is sort of independent of that. In other words, so that I think the complexity that we design in the systems is going to cause these sorts of normal accidents, and it's only worse because, the probability distributions shift on us, and all of a sudden something becomes an issue that we didn't even have an idea about before, much less assign a probability distribution to. So that just exacerbates things all the more.
I think it is true that the state variables, what we believe to be state variables or what seem to have worked in the past, just change over time and just die. But the only thing I'd hope that remains a state variable in many of these asset classes is some form of valuation. You would think that's a constant. Prices need to reflect some expected value of future expected cash flows. That's got to be the case. There has to be an equilibrium with respect to stock bond spread. If you have some equilibrium model with respect to risk premium, and you would think that there would be mean reversion. That you would think could be constant. So if there's one thing that is constant, certainly in my mind, the way we look at the world is that notion. The rest of it works at some points in time. Momentum is a great example of a factor that worked, whether it be post-earnings announcement drift, that worked really well. As you said, as Woody Allen used to say, all you had to do to win the game was to show up, which is what happened in the late 90s with respect to the momentum factor. You had that in your models, it worked, and you looked like heroes, but that's all going away, and earnings quality would go away too after some time, as many other factors. But valuation, I think, across the board, in my view, would be a state factor.
Well, I mean, valuation certainly is kind of the fundamental thing we're trying to do. Right? Buy low, sell high. But I mean, what's valuable changes over time.
True.
And all from different factors. I mean, how many years ago was it that everybody wanted a big car? And where are the big cars now? You get the SUVs, right? Now they're becoming hybrids. I mean, things change. And fundamentally, I agree with the question completely. I mean, fundamentally, what you're looking at is the behavior of a lot of different people and their personal preferences being expressed in the markets. As personal preferences change, things can change. Sometimes ideas spread like wildfire, and everybody suddenly changes their opinion, like in the high-tech crash. And your models, which are working most of the time, are not going to work during such events, precisely because they were tuned to work in the average state when everybody's kind of has a difference of opinion and are buying and selling and comparing kind of how gross overall behavior is expressed in terms of, can be expressed as a Brownian motion plus a drift. But when suddenly everybody decides, no, this is bad, I'm going to run away, and the model isn't going to work.
Yeah, but on a positive note, from that point of view, I remember, I was managing money at the time in a quant way, if you look at the tech crisis, there were very few quant firms that were victim to it. In fact, they were victim of the excessive rationality, let's call it like
Being
that,
out of it.
of saying what Ramu was saying, that is, according to any sensible model, what was happening wasn't rational. Of course, it's very nice to say it now, but we all remember how it was at the time, right? It was usual talks of new paradigm, this time is different, the usual stuff. So, again, yes, we're talking about the flaws. We're looking at ourselves and we're looking at the flaws of quant management, but in reality, there have been a number of circumstances, even recent ones, where quant management has done even a good job of navigating situations in which the models hadn't seen what was happening, and yet managed to resist.
Sure, not everything right. The flip side is paying attention to the things that make sense, and trying to avoid being in the markets where things don't make sense.
Mm-hmm. We have a question.
Hi. May I ask the panel, what is statistical arbitrage and what happened in 2002? And if you're a portfolio manager running StatUp at that period of time, what should you do?
I guess I sort of mentioned that StatArb started with a guy named Jerry Bamberger at Morgan Stanley, who noticed a simple point that when you had two stocks that were very, very similar, sometimes one would run up in price and the other wouldn't, and then the one that ran up would come back down again, and it was simply because of a liquidity need, or vice versa, it's a liquidity event. And so if you took pairs, as pairs trading initially, and if you took pairs that were very similar and basically traded them when they started to revert, you made a lot of money, because either it was a liquidity event or it was a firm-specific risk that could be diversified away if you did this with many, many stocks. So that in a nutshell was the idea behind StatArb, and it got expanded over time, and you had lead lag and all these other things. Morgan Stanley did it. David Shaw left Morgan Stanley and started his own firm to do it. Nunzio Tartaglia, who took over the group, left, and then Peter Muller came and essentially did the same thing with some flourishes. So it was something that many different people were doing over time, and one way or another, in the simplest case, it's mean reversion. So I guess, and you're providing liquidity, you're providing a service to the market in doing this, because by you going in as soon as you see this deviation occur, you're getting liquidity to the person who needs it more quickly. The problem is, a lot of people did it, and by my reckoning, and many other people may have different reckoning, it seemed to me like around the spring of 2002, the game was largely over. A lot of the people doing StatArb started to discover that they weren't making money anymore, and a natural argument could be, and there may be others, would be that essentially there's enough people doing it at that point that there are more liquidity suppliers than were necessary.
And also the way, just to complement this point, with the point that both Rick and I had made earlier on, a lot of the techniques that are now used to put the orders in the market, at least in the equity space, are reminiscent of a statistical arbitrage group of techniques, but as Rick was saying very, very rightly, with a much lower objective. There is just that one of reducing trading costs, so there's much lower hurdle. And so some of those models are being arbitraged, and I personally think that unless you operate within a prop trading team within an investment bank that has zero negative trading costs, now let's not delve into the implications of why that's the case, but let's just say that it may be like that, or if you're working for a colossal shop, and then you can do statistical arbitrage in the kind of no latency space of kind of very, 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 very high frequency stuff, but things that are unthinkable for the majority of managers. So that's what I think is a dead space. Yeah, there's a question there.
To slightly restate the first question and then add a piece to it, we essentially are involved in a soft science. The hard sciences out there, when Newton got hit on the head with the apple, the laws of gravity didn't change. However, when the financial Newton gets hit, that coupling that you're talking about very much comes into effect. So in some respects, the demands on the statistics and mathematics that exist would be a much stronger demand to be done more accurately and precisely in our world, so to speak. Nevertheless, if you look at adjusted R squared, I mean, in the hard sciences, the kind of numbers that we accept in the financial world would be thrown out and totally forgotten about. But we're so desperate to find something because we're so under pressure to find that thing that we can trade, is that we get all excited with beta if it's 30 or 40%. And with the stat arb stuff at Morgan Stanley, 80% was the thing that you charged off on. Is this not an issue that we in fact accept a lower standard than the drug companies do and the other hard science types of peoples deal with now? And that might be the reason we miss the probabilities that blow us up.
Well, if you're waiting for a sure thing, you're going to be waiting for a while, right, in the financial markets? Well, I mean, you're talking about, compared to physics, we're talking about pretty much things that are sure things. If I drop my pen, it's going to hit the table, right? And it's not going to just kind of hang out in the air and then fly off somewhere. Right?
Well, one view the managers take is that transaction costs are very low, as they have been coming down significantly over time, and you can make a little bit of alpha. And it doesn't seem like it is risky to lever it up, even though we agree that that is risky. Feel like you need to do it in order to satisfy the after fee return demand. So part of the issue here is transaction costs. If transaction costs in the past was much higher, some of these that we have today wouldn't even exist, because after transaction costs it was not worth it. Whereas today, you get paid if you're on the indexing side to get the assets. As a client gets paid. It's not that they have to pay for getting indexing fee for indexing strategies. So transaction costs have come down significantly, and people think that they should, as they say, try to pick the nickel that's worth 4.9 cents. In front of a streamroller sometimes.
There was a question in the back, I think. Yeah.
Building on some of the earlier comments, we sort of emphasized that quant strategies tend to be valuation-based, which should be stabilizing. But in Richard's book, he talked a lot about the destabilizing effects during a crisis. And there was a pretty vivid description of the portfolio insurers in October '87. And I was left wondering, how do markets return to some type of equilibrium after that? So like on October 20th, '87 or 21st or whatever, is it just that valuation-based people stepped in and said things are too attractive? Or how do things not continue to destabilize out of control once that kicks in?
Yeah, I think almost every crisis, at least once I talk about, are liquidity-based crises and not valuation-based crises. That is, people have to sell because they have to sell. Not that they think that what they're holding is inherently not worth something, but they're under pressure because they're over-levered or whatever the situation is. And so finally, somebody does step up to provide that liquidity at some price. And then the crisis ends, and if you're a value-oriented person who's very patient, it may be days later, it may be months later, things seem to go back to normal. One of the things that's really unfortunate is that there are a lot of deep pockets of liquidity out there, and many of those deep pockets are in institutions that are afraid to go into the market at the very time that the markets are screaming out for that liquidity. And so some of these events, especially when they're with complex instruments, like when you see with options, you see volatilities go up to 80%, and everybody pretty much knows that it's crazy that the volatilities are 80%, but everybody who's knowledgeable enough to take a position on the other side is already caught up in the crisis, and the institutions that have the capital that could really make a killing for sort of political reasons, nobody wants to stick their neck out and say, hey, why don't we give this a shot?
One last one. Sorry. How do you?
Well, you're saying liquidity-based crises versus valuation-based. I mean, it is kind of valuation-based if you, in a more global sense. I mean, the issue is that the liquidity was cheap and people were capitalizing on that, and when it became expensive, it became there was a problem.
Yeah. So it's the price of liquidity.
Yeah, so it's essentially the price of liquidity that changes and is going to hurt anybody who's trying to trade on it directly.
Last question.
Yeah, when you talk about the decline in alpha, you regularly tend to talk about single asset. Can you perhaps explore a little bit where you think there are possibilities for alpha that is not exploited? For example, cross-asset arbitrage, commodities versus equities, credit versus equities, foreign exchange. Where are, in your mind, some of the opportunities where alpha still has a long ways to go? Do we exploit that?
Well, the hedge fund manager response to that question would be put money in our fund and we'll deliver it to you. So,
I'm sure we all agree
We'll
with that
exploit it
answer.
for you.
So I think the only comment I have is that I think as over time there is decline in many of these factors or mean reversion that people play on. So you need to have multiple things working. Where are the alphas to be traded? I put my money in India, infrastructure plays, if I want a beta play. But that's not the way we look at it. We want to make sure that we don't take directional bets. We add money to our clients in a market neutral sense. So I think trying to go to multiple markets, trying to go to areas where some of these would still continue to work and adding to your portfolio while not increasing transaction cost would be one way to handle it.
I think sort of a natural, if you take the arguments that I think a number of us have been making, it suggests that if there is alpha opportunity, it probably is in longer-term, value-oriented positions as opposed to short-term. I mean, if you take the extreme case of the argument that, high-frequency trading is something that has a lot of focus and is not very sizable, and then you take the argument that a lot of the anomalies are being picked over and may be spurious even to begin with, and those tend to be shorter-term, and that quantitative people by nature have that shorter-term focus because the data are better and you can test a hypothesis more readily, then that sort of leaves the fertile ground to be something that's longer term. And there's another reason institutionally why that may be true. Hedge funds are kind of like public corporations. Like a public company has to worry about its earnings next quarter and behave accordingly, whereas the private company can sort of build for the future. Hedge funds have to worry about their returns next month. And so they're really focused on what's going on with the company this quarter. Most hedge funds tend to be somewhat short-term oriented, even if they're fundamentally based. And they have to be short-term oriented also because if they are highly levered, they can't afford to just hold for the long term. So insofar as you have a lot of talent and focus and levered liquidity focus on the shorter term, that sort of suggests maybe the ground's a little more fertile as you look further out.
Opportunities, I mean, I think it's in the complexity, largely speaking. It's in trying to get a handle on some of the complex interactions that people aren't carefully, don't really completely understand yet. To the extent that you can get a better understanding of them, then you can capitalize them. Like, playing credit versus equity with interest rate controls gets you into 3 different markets simultaneously. There's not a lot of people that are good at on understanding and capitalizing on all 3 simultaneously.
Well, I think this concludes our panel. It was a very, very interesting one. Very, very good speakers and interesting opinions of opportunities and challenges ahead. Things happen in the past and opportunities and challenges ahead for quant management. Let me ask you to thank our panelists in the usual way. And let me pass the baton on to David again.
We'll be taking a 30-minute coffee break. Please return promptly at 11 o'clock for Andy Lowe. The other thing I would ask you is for those who have not filled out the hedge fund valuation form, we'll be using that for the afternoon panel, so if you please bring that back to the front desk. Thank you.
Or doing the quantitative stuff is, I think, I'm coming more and more to think that's the way to do it. That it's more the accounting and the answer data, as opposed to take data and saying.
Yeah, I don't like that. I mean, I don't understand.
Yeah, it's good.
I got yours. You got my money already.
There were some forms here. May I grab the...
You got my money already. You have got all of our money.
Yes.
Can I grab the forms, the sign-offs?
Oh, here it is. That's mine.
I didn't have one to sign.
I'm sorry?
Thank you.
I don't have one.
I think Robin's still here.
Yeah, it's clear though, even with the recording, do I have to worry that some
Press.
journal? Yeah.
I mean, it's clearly stated that this is authorized, yeah. Yes. It's,
No, I want to.
Oh, just a sec, let me just, I have to just sign this thing. So that they can record, use the recording.